This is Mike. This is Mike's business. Although Mike owns Mike's motorbikes, we should be careful when we consider the financial activities of Mike versus the financial activities within Mike's business. They are not the same. Today we'll be looking at the accounting principle known as the economic entity assumption. What is the economic entity assumption? Well, first we have to understand what generally accepted accounting principles are. Generally accepted accounting principles, or GAAP for short, are a commonly accepted set of standards and principles used by accountants in order to uphold financial integrity. One such principle is the economic entity assumption. The economic entity assumption states that the financial activities of a business and the financial activities of that business's owner must be separate. This allows one to examine the business's accounting information, knowing that it has not been altered or influenced by any events outside of the business, such as through the owner's personal activities. So what does this mean? Let's look at some examples. Number 1. Mike buys supplies for his business. 2. Mike buys groceries for his dinner. 3. Mike receives payment for motorbike sold. 4. Mike takes a holiday. 5. Mike has a store built in a new location. 6. Mike sells his personal motorbike to a friend. Let's take a look at how we can separate these events in consideration of the economic entity assumption. Mike buying supplies for his business is a business transaction. Mike buying groceries for his dinner is a personal transaction. Mike receiving payment for motorbikes sold is a revenue and a business transaction. Mike taking a holiday is personal. Mike having a new store built adds to the business's assets and is a business transaction. Mike selling his personal motorbikes to his friends is a process that took place outside of the business. The motorbike belonged to Mike and was not part of the business's inventory. Mike's friend paid Mike directly and none of the cash went through the business. The transaction should not be recorded in the business as this can create inaccuracies in the profit and loss statement. So this is a personal transaction. So we are left with only the business transactions and activities. The economic entity principle can also apply to separate business divisions within a company. For example, suppose Mike runs another business in which he provides camping gear and hiking tours. Although Mike owns both these businesses, the economic entity assumption states that these two businesses should remain as separate entities. That is, the financial activities and transactions of one business division should not affect or influence the other, and vice versa. That's it. Hope you learned something about economic entity assumption. Thanks for watching.